Hello and welcome to our Q2 Global IFRS Update webcast for 2025. We're almost halfway into 2025 and the first half of this year was filled with a lot of uncertainty. So in today's webcast, we'll briefly touch on the impacts of those uncertainties. We'll also have an update on the latest on sustainability reporting, and we'll also discuss amendments that are applicable for the first time for 30 June reporters, as well as a new standard and amendments that may impact entities in the near future. My name is Gerda Burger, and I'm joined today by Olaf Pusch and Dekiezer from our Global Corporate Reporting Services team. Now, uncertainty seems to be the word that describes our current environment. We discussed tariffs and the uncertainties it brings in our Q1 webcast earlier this year. And since that webcast, we've seen increasing trade tensions, the imposition of new tariffs, followed by retaliatory tariffs, increases and decreases in tariffs, all of which disrupted global trade and created more uncertainty for businesses. We've also seen the continuation and even the escalation of geopolitical conflicts around the world, along with other factors such as climate change and the disruption AI brings. So there's a lot of uncertainty and risk that businesses must navigate. Olaf, if I go to you, shall we start with the geopolitical conflicts and the impact that may have on financial reporting?
Yeah, sure, Gerda, and hello to all of our viewers. Indeed, as you said, the issue of geopolitical conflicts, that's been going on for quite a while, for the past few years. Entities had to deal with all these uncertainties, and in fact, in one of our previous webcasts, we did discuss the impact of these conflicts on financial reporting for entities. And we highlighted a couple of examples like sanctions, trade restrictions, impairments for both financial as well as non-financial assets, and possible going concern issues in the worst case even, just to name a few. And if we focus on entities now, and I guess that's why we're having this webcast for, say, June 30, 25 year ends, then I guess it's important for management to relook at all these issues because they didn't go away. The same argument still applies, just a different period. So you just have to look at this again and then kind of consider any new information that you would have received in the meantime. And of course, hand in hand with these uncertainties, arguably even more important maybe are disclosures in financial statements. So meaningful disclosures is what investors are looking for that entities would need to provide, especially around key assumptions, key judgments that management has made. And that's particularly important when you come to measurement estimates and uncertainties. And of course, there are many more areas than I've just given in my few examples, and we've actually got an in-depth publication out on Viewpoint that I would encourage our viewers to have a look at again.
Thanks, Olaf. And then what about tariffs?
Yeah, that's a good point. Tariffs is actually very similar, if you think about it, to geopolitical conflicts because it just affects financial reporting due to the high level of uncertainty that's inherent in these topics. And as we mentioned before, we discussed these accounting impacts on tariffs in our Q1 webcast. And as a recap, we've got them on the slide here for our viewers to refresh their minds on these. And again, they remain relevant for June 30, 25 years as well, just as all the uncertainties around the geopolitical conflicts. Again, we don't want to go into much detail on these considerations that you see on the slide here. Again, just important for management to relook at these again, update any estimates that you've had in the meantime with regards to the tariffs, and be very fulsome and meaningful in your disclosures.
Thanks, Olaf. And similar to our geopolitical in brief, we also have an in brief that summarizes tariffs.
Yes, indeed we have.
Yeah, so if our viewers would like to have a bit more detail, they can have a look at those two in briefs. Now, I think, in an ever-changing world with so many uncertainties, it's definitely something that we need to be aware of how the variety of ways of how financial reporting can be impacted. Now, let's move away from financial reporting for a bit and catch up a bit on sustainability reporting. Katie, you were part of our team that just, I think last week recorded our Q2 Global Sustainability Reporting webcast. And in that webcast, I know you provided an update on sustainability reporting and specifically the EU Omnibus proposals and some of the upcoming changes to ISRS. Would you mind giving us a bit of a summary of that?
Yeah, sure. So as you mentioned, we did a webcast on this last week or a week and a half ago. And in that webcast, we go into a lot of detail of the changes that are coming that we see in Europe around the omnibus and around the ESRS revision. So I'm not going to go through all the detail again today. I'm just going to give kind of a high-level summary. And I would really encourage our viewers, if you do want more information on what's going on in Europe and with sustainability reporting more generally, take a look at that webcast. I think it is available on Viewpoint now for you to have a look at. So just as a kind of high-level summary of what's going on in Europe right now, there's sort of two pillars to what's happening. So on the one hand, we have the omnibus proposal, and on the other hand, we have the ESRS revisions. So on the omnibus proposal, what's going on at the moment, you have the European Parliament and the Council of the European Union, both in sort of internal negotiations around their proposed amendments to the omnibus proposal, which would amend the CSRD and the CSDDD as well. So the Parliament and the Council are doing that right now. They will enter into what's known as the trilogue negotiations, we think around October or start of November this year. And in those negotiations, the Parliament, the European Commission, and the Council of the European Union will come together to negotiate on the final amendments to that text. We don't know exactly how long that will take, but our current expectation is that the trilogue negotiations will probably come to a close around the end of the calendar year or the beginning of 2026. And just as a reminder, those amendments will affect not only the scope of who has to report under the CSRD, but also some of the content of that sustainability reporting. So that's on the omnibus side. Now on the ESRS revision, so EFRAG has been working on revising the ESRSs themselves. They've been they've been given a mandate by the European Commission to simplify those standards. So they've been working on that. And we expect them to publish a public update, a written update of the status of that project on the 20th of June, so in just a couple of days. And then the next step is that EFRAG will issue a full public draft of the revised ESRSs for public comment. We expect that to be published around the end of July with a 30-day comment period. And at that point, EFRAG will redeliberate, and then the expectation is that those revised final ESRSs will be delivered to the Commission in October. So a lot of moving parts, a lot of things going on right now, but we do expect that by the end of this calendar year, we will have more clarity both on the content of the revised ESRSs and the omnibus itself.
Thanks, Katie. And what is happening from an ISSB point of view, so with their IFRS sustainability disclosure standards?
Yeah, so lots of things going on the ISSB side as well. Again, there's a lot of detail in the Global Sustainability Reporting webcast that our viewers can go and have a look at. But just to give kind of a quick overview here, so the ISSB back in 2024 approved their work plan, and that 2-year work plan had 4 projects in it. The first one being supporting the implementation of IFRS S1 and IFRS S2. Then the project to enhance the SASB standards, and then the last 2 were both research projects on the topics of human capital and biodiversity, ecosystems, and ecosystem services. So the ISSB has been working on those 4 projects, and maybe just like a quick update on a couple of those projects. So on the project on supporting the implementation of IFRS S1 and IFRS S2, the ISSB has issued an exposure draft with some targeted amendments to GHG emissions disclosure requirements. That exposure draft is out now. The period for public comment will close on the 27th of June, so shortly. After that comment period closes, the ISSB will enter into redeliberations, and we expect the final amendments to come again around the end of this calendar year. And then on the second project that I mentioned, the enhancement of the SASB standards, so the ISSB is going to issue an exposure draft at the start of July. That exposure draft will have enhancements to 9 SASB standards. So that will be 8 industry standards within the extractives and mineral processing sector, plus 1 standard related to processed foods. In addition to those 9, the exposure draft will also have targeted amendments to 41 further industry standards. So it's going to be quite a large exposure draft with a lot of detail in it. One thing I will say, though, is that the targeted amendments to the 41 other standards, those amendments are, the way the ISSB describes them is they relate to a handful of specific disclosure topics, and they're really kind of more for consistency across different industry standards. So the enhancements to the 9 are probably more significant enhancements, and then we have targeted amendments to the other 41. As I said, we're expecting that exposure draft at the start of July. So the ISSB approved or ratified that exposure draft in a board meeting a couple days ago on the 18th of June. And at the same time, they approved a comment period for that exposure draft of 150 days. So taking us through into Q4 of this year. So those are the 2 exposure drafts. In addition to that, the ISSB has also been issuing educational material on IFRS S1 and IFRS S2. Most recently, they issued some educational material on greenhouse gas emissions disclosures. And they've been working on the research projects for human capital and biodiversity ecosystems and ecosystem services. So again, a lot going on the ISSB side. As I said, our webcast, our Global Sustainability Reporting webcast goes into this in more detail, so our viewers can have a look at that on Viewpoint as well.
Thanks, Katie. There's clearly a lot going on and a lot of fast-moving parts to this. Now, if we move away to financial reporting again, the ISB is close to finalising a project they have on climate-related and other uncertainties in financial statements. So looking at climate from risks from a financial reporting point of view. Can you tell us a bit about that project?
Yeah, sure. So that project is a response from the IASB, not the ISSB, which I always struggle to distinguish between those two when I'm speaking. So the IASB responded to concerns really that information about climate-related risks in the financial statements was insufficient or inconsistent somehow with information that might be getting provided outside the financial statements. So in response to those concerns, the IASB developed some examples, and those examples illustrate the ways in which IFRS accounting standards, the existing requirements in the IFRS accounting standards, are to be applied to climate-related uncertainties and other uncertainties. So these examples, they are just illustrative examples. So the IASB is not amending the IFRS accounting standards. However, companies might not have been applying the existing requirements in the manner that's now being illustrated in these examples.
So, and Katie, I understand that this may already be relevant for 31 December 2025 reporters.
Yeah, so the timing's really important here on this one. So as I said, these aren't amendments to the accounting standards. So these examples, they're illustrative examples, they aren't an integral part of the IFRS accounting standard. And what that means essentially is that there is no effective date for these illustrative examples. There's no effective date, there's no transitional requirements. So the IASB is proposing to allow sufficient time for entities to implement these changes, similar to the way that they would deal with agenda decisions from the IFRS Interpretations Committee, or the IFRIC. So with that in mind, the ISSB said that they are intending to publish these examples in October of this year. So as you mentioned, that's probably going to be relevant for companies that have December 2025 year ends. They're already going to have to be considering these examples. So to try to kind of help with that implementation process, the IASB has said that they will be publishing a near final draft of these examples in the third quarter of 2025.
Okay. And in Katie, you talked about, part of the aim of this project was because there might have been inconsistencies between what's reported outside of the financial statements and inside. So I guess this is probably also a good time to think about connectivity.
Absolutely. So these examples are just about disclosure, but they should be, reminding us that connectivity between sustainability reporting and financial reporting is really important. So climate-related risks, these are risks that are really important to many investors, and so entities should really be ensuring that all material information about these sorts of matters is provided. The IASB, they're considering whether to continue working on this project. So for now, I suppose one thing we can talk about really is that entities can be doing right now is ensuring consistency in key climate-related assumptions between sustainability reporting and financial reporting, if those assumptions are relevant to the recognition and measurement of transactions and balances. And I guess the other thing to be thinking about in line with these new illustrative examples is where there is commentary or information in sustainability reporting that isn't reflected in the financial statements, entities should be thinking about providing additional information to explain the basis for that, explain why that information is maybe reflected on a different basis in the financial statements. And yeah, I think we have, if our viewers are interested in more information, I think we do have an in-brief and an in-depth on Viewpoint right now, providing guidance around incorporating climate-related matters into financial statements.
Thanks, Katie. And as a reminder, we will link all of these materials that we're referencing in the description of the webcast on Viewpoint. Now let's move on to the next section of our webcast. So 30 June reporters will be applying certain amendments for the first time as they're preparing their period-end financial reports. Now, these amendments include amendments to IS1, an amendment to IFRS 16, as well as supplier finance arrangements. Now, if we start with IS1, the IS1 amendment is likely to impact the broadest group of preparers that prepares financial statements for the first time in June. Now, the aim of the amendments was to provide more information or improve the information that's provided when an entity has a right to defer settlement of a liability that is subject to compliance with covenants. Now, the core principle when loan arrangements are classified as current or non-current is that at the reporting date, the borrower needs to have a right to defer settlement of that liability for at least 12 months after the reporting date. Now, if the answer is yes, that they have the right to defer, then the answer is, the liability is non-current. Now, that seems quite simple, but it gets trickier when we have covenants involved. Now, the amendment to IS1 clarified that when a loan is subject to covenants, when thinking about whether the classification should be current or non-current, only the covenants that they need to comply with before or at the reporting date needs to be considered with. So when the entity determines whether there's a right to defer settlement for more than 12 or at least 12 months after the reporting date, they don't look at any covenants that needs to be complied with after the reporting date. There's also new disclosure requirements that has been introduced by these amendments, and some of them include that if there is any facts or circumstances, or if there's any doubt that you may be able to comply with the covenants, any facts and circumstances that goes along with that needs to be disclosed. Now, as I said, it's a bit more complex than just looking, whether you can defer settlement. So with the current uncertain environment, it's clearly an area that more and more preparers need to pay attention to. We also covered this, Olaf and myself actually, in our IFRS Talks podcast. So if you would like more information, listen to our May IFRS Talks podcast. Olaf, maybe let's go back to you. Would you like to give us a bit of an overview of the supplier finance arrangements?
Yeah, I can certainly do that, Gerda. Thanks. So this has been on the wish list for investors for a very long time, and the ISSB has now amended IS7 and IFRS 7 to basically improve the disclosures that entities would need to give if they entered into supplier finance arrangements. And the information that users were really after is information about the liabilities that are subject to supplier finance arrangements, the cash flows that are associated with it, and the liquidity risk that arises from it. When you can picture a simple scenario where an entity has many supplier liabilities outstanding, maybe hundreds, maybe thousands, and if they now enter into supplier finance arrangements with these, putting a bank in between so that they can delay the payment of these individual supplier invoices. Comes at a cost, of course, but it's worth for the entity because they can delay the payment. Then that concentrates the relationship to one or two banks that are included in these arrangements. And that's important for investors to know because there's liquidity risk associated with it now, especially as you just said, maybe there are covenants involved in these arrangements with the banks that might then lead to earlier repayment as initially planned. So it's quite important for investors to know these arrangements. And so if you've got material supply finance arrangements as an entity, then these disclosures would need to be given. And we've got them on the slide here. So they include terms and conditions of the arrangements. They include information on where the liability is presented on the balance sheet, how much of the liability was already paid for by the banks to the supplier already. And there's a couple of others, as I said, there on the slide here. And the important thing for entities as well is that they need to think about the process that's involved in getting this information to come up with the disclosure, because it might involve actually reaching out to the banks to see how much they've already paid the individual suppliers for, because that would need to be disclosed. So there might be some difficulties or some work involved in getting this information to comply with the disclosures. I mean, there's a piece of good news.
It's always helpful.
It's always helpful, yes. Comparative information does not need to be provided in this case, so you can start off with the current year and then build the comparative information for the following years.
Okay, and I think we also have an in-depth that kind of summarizes a whole, or goes holistically into supplier finance arrangements. So again, if you want to kind of brush up your knowledge on supplier finance arrangement, it will be good to look at that one. So Olaf, IFRS 16 is the last one that remains of this package of amendments. So will you take us briefly through that one?
Yeah, I can do that too. So this, I'm glad you put that last because it's a little bit of a minority sport perhaps. It's quite niche. So this applies if you are in a seller-lessee kind of situation. So you sell an item of PP&E perhaps and lease it back. And if that's not niche enough, I mean, that's maybe not so niche, but if you then have the lease payments on a variable term, this is when this amendment starts to kick in. So it's a narrow set of circumstances. You need to be a seller lessee and then have variable lease payments attached to it. And we've had a couple of years back in 2020 an IFRIC agenda decision where the committee said basically on day one, if you enter into this sale and leaseback transaction and have the variable payments, that you shouldn't recognize a gain when you recognize your right of use asset. And because the lease payments are fully variable, the core principle in IFRS 16 is that variable lease payments aren't recognized as a liability. But the IFRIC has made clear that when it comes to sale and leaseback transactions, then you would estimate your lease liability for this and recognize the liability and not recognize this gain, because in substance there is no gain. And then the amendment now to IFRS 16, which you were asking about, this is now a follow-up, I guess, from the original IFRIC agenda decision, which dealt with day one accounting. This amendment now to IFRS 16 deals with the day two accounting, i.e. the subsequent measurement of this lease liability that you have booked, which is backed basically by these variable lease payments.
Thanks, Olaf. And as Olaf mentions, this is pretty niche, so it's a narrow kind of subset of lease arrangements. And like Olaf mentioned, it's really seller-lessee accounting if the lease payments include variable lease payments. And again, we have an in-depth on this one that's available on Viewpoint. Now, Olaf, it's not an amendment, but I think another topic that preparers should be aware of for 30 June is hyperinflation. So Can you tell us a bit more?
Yeah, it's about twice a year where we get really active in this analysis. So we've recently issued an in-brief that sets out a list of hyperinflationary economies for 30th of June period ends and onwards. And the basis for all of this is the IMF World Economic Outlook report that comes out twice per year. And the last one was released in late April this year. And of course, we've looked at this report that gives some details, some data around current and projected levels of inflation for all territories on the planet. And we've used that data in our assessment on whether we think an economy should be considered hyperinflationary or not. Coupled, of course, with qualitative factors as is required by IAS 29. So we take a good look and we take a mix of the qualitative and quantitative indicators to make up our mind on whether we believe an economy should be considered hyperinflationary or not. And if you look at our latest in-brief that you referred to, the most significant changes or updates, I guess, to the one that we issued before probably relates to 3 countries that I would like to point out. The first one being Burundi, which is considered hyperinflationary now for June 25 period ends onwards. The second territory is Nigeria. This is one that should be monitored pretty closely, but currently we don't expect it to become hyperinflationary for June 25 period ends onwards, so that's good news. And then finally, another piece of good news, Ethiopia is no longer considered to be hyperinflationary from June 25 onwards. So these are probably the 3 territories that stick out most. But again, I'd encourage everybody to look at the list of the economies that is listed in the in-brief, and maybe also remind people that IAS 29 is also relevant for groups that have subsidiaries that have a functional currency in one of these territories that is on the list in that in-brief.
Thanks, Olaf. This brings us to the end of our section of the webcast that deals with 30 June reporters. So now let's move on to the next section. Now let's move to what is effective, not immediately, but in future. So we're talking 2026, 2027 here. The first one we want to talk about is amendments to IFRS 7 and IFRS 9. Now, the ISSB issued a whole package of amendments to these 2 standards with an effective date of periods starting on 1 January 2026. We're not going to talk through all of them today, but we are going to talk through the part of the amendments that's probably the broadest kind of impact on if we think about the range of entities that's impacted by them. And that relates to electronic cash transfers. Now, although today there is a clear trend for most businesses to get, faster and more instant payments, many payments around the world still is executed through electronic payment systems or using checks, for which settlement takes a couple of days to clear. Now, this gives rise to an accounting problem. Basically, kind of what do you do with the cash transfer and the related balances that are being settled in that transit period between when you initiated the payment and when it is actually completed. So if we look at a typical example, if we take an entity, let's call it entity A. If entity A has a balance that is due to another entity, let's call that entity B. If entity A, at a day before the reporting date, initiates a payment to entity B, but that payment system takes 3 days before the payment is reflected in entity B's accounts, meaning it's a day after the reporting period end for entity A. The question is, when can the paying entity, which is entity A in this example, when can they de-recognize the cash and the payable? And for the receiving entity in this example, entity B, when can that entity recognize the cash it receives and de-recognize the receivable? Now, the amendments to IFRS 7 and IFRS 9 clarified that the date of recognition and de-recognition of financial assets and financial liabilities. And that clarification in this example would be day 3 for both entity A and entity B, because that's the date that the cash or the payment process is completed, not when entity A initiated the payment.
Yeah, and I understand, Gerda, that there is an optional exception that the ISSB has built in, right, to help companies out?
Yes, that exception, if you apply that, then the entity is permitted to de-recognize a financial liability at an earlier date. However, this is a really there's specific conditions with this exception, so it's quite strict. It's only available for financial liabilities, so not for financial assets, and it's only where payments are made through an electronic cash payment system, so not for checks. And then additionally, when the payment is initiated, the paying entity should not be able to practically recall that instruction or have access to that cash again. And the payment process needs to be through a standard or the system that is used for that payment process should have standard administrative processes, and the payment period should be quite short. So it's clearly, something that entities may need to want to consider to examine the terms and conditions of the payment methods they use, so that they can make, some informed decisions about how it impacts their accounting policies and their processes and controls around accounting for these cash transfers. Again, we have more detail on this in our IFRS Talks podcast. So if you're interested, have a listen to our April IFRS Talks podcast. Now, Olaf, moving a little bit away from financial instruments, if we then look at presentation and disclosure, we've had a lot of discussions recently about IFRS 18. And for our viewers, I think we've spoken about this before on the webcast. IFRS 18 was issued last year, and it effectively replaces IS1. Yeah. So we probably don't want to go in all that detail, Olaf, but I think it might be useful just to kind of have a brief overview of the key changes compared to IS1.
Yeah, sure, Gerda. Happy to give that. This, as you said, this continues to be a standard where we have lots of discussions, and entities are probably in a stage now where they're trying to digest the standard and trying to train people up. So I say it's probably worthwhile, even though we've covered some of this before, just to remind people of the high-level changes so that they can keep that in the back of their mind as something that's on the to-do list. So, as you said, it replaces IS1, the presentation of financial statement standard, and mainly the reason was because investors have asked for more comparability between entities because IS1 wasn't really that strict, and also to be just more transparent around the performance specifically. So you see most of the changes in IFRS 18 actually relate to the performance statement, so the profit and loss statement. And many of the principles in IS1 still remain, so they didn't completely scrap IFRS 1, but copied some of the stuff over into IFRS 18, but then IFRS 18 brings additional rules and requirements on top of that, so it's a much enhanced presentation standard now going forward. So maybe three things that I want to highlight that are kind of new and worth looking out for. So the most significant change probably relates to as I said, the statement of profit and loss, where we've now got 5 categories to disclose. So we have to classify items of income and expense into operating, investing, financing, tax, and discontinued operations. And we also have a number of defined subtotals that again help with the comparability between different entities that companies would have to now provide as part of the statement of profit and loss. Then we've got a couple of new required disclosures in financial statements, and maybe the most significant one here relates to what the standard calls management performance measures. So these are maybe similar-ish, but not exactly the same as non-GAAP measures. So if you have those and you disclose those outside of your financial statements, then the requirement actually is in the standard to bring disclosure into the financial statements with regards to these management performance measures. And they have special definitions in the standard around them. So that could be a big change for entities, because they now need to bring into the audited set of financial statements disclosures around these portion of non-GAAP measures.
Okay, so I guess, Olaf, there's certain requirements to meet the definition of an MPM, but then there's also disclosures around that.
Yeah, that's right, and they need to be audited. So there need to be processes and controls around the generation of this information that goes into the financial statements. So some extra work for companies to do here. And then thirdly, maybe that's the other big change, is that now IFRS 18 brings in some enhanced principles on aggregation and on disaggregation, as well as coming up with the notion of a useful structured summary. So that kind of underlays everything now. So the statement of profit and loss, the statement of financial position, so all of those will need to be structured in a way that is useful, and also aggregate and disaggregate information in a useful manner for readers. So we don't want to aggregate too much, because that would condense and destroy information, but we also don't want to disaggregate too much, because then you can't see the woods from the trees anymore. So investors have specifically asked for that, and that is something that companies will need to look into.
Thanks, Olaf. And what about the effective date?
Yeah, the effective date is 1st of January 2027, so from that day onwards. So Early application is permitted, but when you do apply it, you have to apply it retrospectively, so you need full comparatives. So actually, if you think about that, 1/1/26, if you have 1 year of comparatives, then it's not really that long anymore until that kicks in. And we also have some reconciliation requirements, moving from IS1 over to IFRS 18.
Thanks, Olaf. And as Olaf mentioned, there's not a lot of time before 1 January 2026, so it may be a presentation and disclosure standard, but entities need to make some key determinations. And also, as you mentioned, the non-GAAP measures is brought into the financial statements, so there might need to be certain changes to processes and data, etc.
Yeah, it's. I mean, it probably doesn't only impact the presentation, but there's also impacts possible on other things in the entity, like remuneration, for example. Right, if you remunerate your management based on certain KPIs, then they might be impacted by that presentation. Your covenants might be impacted. Your IT department will need to be brought in line to ensure that all the data can be collected and aggregated in a proper way. So it's not just a reporting issue.
Thanks, Olaf. This brings us then to the end of today's webcast. Olaf, Katie, thank you for sharing your insights with us. And to our viewers, thank you for taking the time to watch this webcast. We hope it's helpful. And we're looking forward to see you again in the future.